Get started. Welcome back to this lesson. It is Introduction to Financial Accounting, and this being our first lesson, we shall look at the basics on this course. For a start, we ask ourselves, what is the nature and purpose of accounting? If you have started your foundation level, having not done accounting in high school, or having not done accounting before, perhaps a degree in accounting, we need to ask ourselves, how do we define accounting, or how do the technocrats or professionals view accounting? So that as you grow in this course, you'll be able to have a correct definition of accounting. There are those who view accounting as a science, and they say that accounting is the process of identifying, measuring, and communicating economic information to permit informed judgment and decisions by the user of the information. Therefore, you can view accounting as a science. You can also view accounting as an art, where we say that accounting is the art of recording. In this case, we call journalizing. We shall look at the journals as we move on. Classifying, this is posting to the ledgers, summarizing in a significant manner and in terms of money, transaction, and event, which are in part at least of a financial character, and interpreting the results to the interested users. That is perception of accounting as a science. There are those who view accounting as information system, and they say that accounting is a service activity which functions to provide quantitative information, primarily financial in nature, about economic entity that is intended to be useful in making economic decisions. So these are three different ways that we can define or view accounting concepts. Now, having looked at the different ways we can define accounting, we move to the next stage and ask ourselves, from the above definition, what do we pick out that is common among the three? One, we are finding that accounting involves identifying. Therefore, in accounting, this is the process of recognition or non-recognition of business activity as accountable event. You bring recognition means bringing your entries into a books or removing these entries from your books. That is a recognition. Then, stated differently, this is the process by which you determine if an event has accounting relevance. That is the first thing that is coming out from definition of accounting. Measuring means accounting, this is the process of assigning monetary amount to accountable events. When you're measuring the value of a vehicle, you are assigning a monetary value to that vehicle. In other words, you are now recording your assets or your motor vehicle in form of money. Communicating, in this case, we are saying that as we could notice with the above definition, one main similarity between three is the impact of communication. You are identifying and measuring an item so that whoever is going to read it can make sense, can be able to perceive the information clearly. Now, The second part there, we also seen that accounting involves recording, meaning as you monetize your item, as you make your item have value or you measure the value of your item, you record. Therefore, accounting term for recording is journalizing. Journalizing means putting your item into the correct journals. All the accounting events are recorded in a journal. Classifying means that the accounting terms for recording is posting. All accountable events that are recorded in the journal are then posted into their ledgers. We shall look at these journals and ledgers as we move on. You also seen that accounting involves summarizing. The item that has been journalized and posted are summarized into 5 basic financial statements. We shall look at this financial statement in the near future. We have the balance sheet, we have the cash flow statement, we have income statement, and many others. So, in this case, we look at that definition, and that definition says that accounting has quantitative information, yeah, and it also has qualitative. Quantitative is the bulkiness, and qualitative is the usefulness. And all this refers to the financial information that has been expressed in monetary terms. So that is how we define accounting, and we find the relevance of accounting from those definitions. Now, we move on and ask ourselves, when you are studying accounting in its application, why do you need this accounting? The first thing we are saying, accounting, the major objectives of accounting is to have systematic recording of transactions. Systematic in this sense that they're in a certain order. We say that the basic objective of accounting is to systematically record the financial aspects of a business transaction. So that is the first basic objective of accounting. Even as you study this and apply it in day-to-day life, you need to know that we are picking this accounting concept so that we are able to record our transaction diligently. And then we say that the second objective is ascertainment of results of above recorded transactions. Whatever you have recorded, can you make sense out of them by preparing some sort of or some financial statements? We say that accountant prepares profit and loss account to know the results of a business operation. You have recorded your transaction. How do you make the information meaningful such that the third user can be in a position to understand this information? Then you're saying accounting can also be useful in ascertainment of financial position of the business. Financial position means when you start your business with a certain amount of capital, let's say 100 or let's say 1 million, what is the financial status of your business after 1 year? Is this capital still there? What have you bought with this capital? So that means you are ascertaining the financial position of that business using the accounting concept. We also say that providing information to the user for rational decision making. If someone wants to give you a loan, you need to read the information from your financial statements and determine whether you qualify or you are worthy to grant you a loan. Simply because your financial statements should be rational, should be able to communicate, so that whoever is making decision, make decision on a solid ground. Finally, we are saying that Another objective of accounting is to know the solvency position. Solvency in this case, we are asking ourselves, is your business in a going concern? Is your business able to make profit? Solvency, is it going to close down any soon? So those are the basics objective of accounting. And if there's any question, kindly chat or place it on the chat so that I can be able to act as we move on. Now, we look at who are the users of accounting information. Correct, you have recorded your accounting information. Who are going to make use of this information? The first and major basic use of financial information are the employees. If you are an employee working in an accounting, finance, or sales department, definitely accounting information is very essential. Employees need accounting information to know if the business could provide the necessary benefit that is due to them. You cannot be in a company that is making losses and expect that company to pay you. So as an employee, you need to make good use of the accounting information that are prepared by your company. Suppliers and other trade creditors, for them to lend and provide credit to the business organization, they require to use accounting information for solid decision making. Suppliers and trade creditors are provided with this information so that they are able to make good judgment. Customers, how do customers need accounting information? Or clients? Customer need accounting information in order to determine the continuity of the business. How long is the business going to serve them is of their interest. So they will look at the financial information or financial statements so that they can be able to judge. Of importance are the lenders. Lenders cannot sell their loans to organization or people who have chances of default. So we are saying that lenders have similar needs as suppliers where they interested in accounting information. Of course, to judge the ability of the borrower. We also have investors and businessmen. Investor needs accounting information in order to make relevant decisions. You want to buy shares to that company. You want to buy whatever items you want to engage in terms of business. Then you need to know how is the business being ran. How is it profitable? And finally, we say that the general public, we need this information to know whether our economy is growing. If the economy is doing well, then companies will also do well. If the economy is doing badly, we expect the companies will also feel the same. Because when the economy is doing badly, the purchasing power of the consumer reduces and the companies will make losses. Now, I hope up to that point, I'm very clear. We look at accounting equation. Accounting equation is summarized into two things. In fact, three. On the left-hand side and on the right-hand side. The left-hand side, we have assets. And the other side, we have liabilities and equity. If you start your business, the amount of assets should be the same as the total amount of liabilities and equity. In what sense? If I'm starting a business with 100 million, this is 100 million. I transfer this 100 million and buy assets. So it means the 100 million, which is my capital, will have an equivalent assets worth 100 million if all the assets were utilized. I can see a message. Let me see. Okay. I'm saying accounting equations is basically the point down there, that all the assets in a business setup should be equals to liabilities plus equity. When you prepare the financial statement of financial position at the end of the year, this law should agree that the assets that you have at the end of the year should be equals to the amount of capital that still exists in your business. Otherwise, you'll have made some errors somewhere. Now, what are these assets? I've mentioned about assets equals to equity plus liability. Now, an asset is a resource that is owned or controlled by a company to be used for future benefits. Simply, an asset has economic value. It promises flow of cash flows in the future. So some assets are tangible like cash, while others are theoretical or intangible like goodwill or copyrights. All of them are assets. We have tangible assets and we have intangible assets. Now, at this point, I ask you, what is a goodwill? A goodwill can be defined in many ways, but the best and the faster way to define your goodwill, it is the excess of your selling value. If you are selling your business, let's say 100,000, and the total assets in your business worth 80,000, the difference between 100,000 and 80,000 is your goodwill. That means the excess of the net realizable value of your assets. Another common asset is receivables. Receivables, these are amount you owe to the debtors. This is the promise to be paid from another party. That means receivable arises when a company provides services or sell product to someone on credit. Receivables is also another term for debtors. Yeah. So all these assets are resources that company can use for future benefit. And here is some common examples of assets. We have cash, account receivable, prepaid expenses. We are going to deal with this in details. By the end of this course, there is a lot we're going to do with these computations. We have vehicles, building, goodwill, copyrights, patents. Now, we say that in accounting equation, asset is equals to equity plus liabilities. Now, what are these liabilities? What are these liabilities? A liability, in its simplest term, is an amount of money owed to another person or organization. Assets, you, like the one we're talking about, receivable, people will pay you. Liabilities is you to pay. So you say liability in simplest term is amount of money owed to another person or organization. Saying differently, if you have a loan to pay, then that is a liability. If you have debt to pay, that is a liability. Other expenses you have not paid to pay, yeah, that becomes a liability. Accrued ones. Yeah? So a common form of liability is payables. Yeah. And we have several examples. We have accounts payable, bank loans, lines of credit, personal loans, officer loans, and earned income. All those are liabilities. And of course, capital, you all know, equity or capital is what you initially bring in to start your business. Here we're saying that equity represents a portion of the company asset that shareholders or partners owe. In other words, the shareholders or partner owe the remainder of assets once all the liabilities are paid off. You see, that is an extension, an extended definition. Huh? But simply, we are saying, if you are a public company, you issue shares to the public. The amount of money you collect from the public is called equity, which now form part of the capital. If it's a private company, the amount of money you inject into that company becomes your equity if it is in form of shares, yeah, or capital. So owners can increase their ownership share by contributing money to the company or decrease equity by withdrawing. When you have drawings reduces your capital. Examples of common equity, we have owner's capital, owner's withdrawal, revenues, expenses, common stock, paid in capital. So those are different forms of equity. Now, I told you earlier that expect you in this lesson you'll be having a calculator, and we want to look at an example together. The same example, let's take a look at the formation of a company to illustrate how the accounting equation works in a business. Ted is an entrepreneur who wants to start a company selling speaker for car stereo system. After saving up money for a year, Ted decided it's time to officially start his business. He forms Speakers Line and contributes $100,000 to the company in exchange for all the newly issued shares. He has issued shares and he has received $100,000. This business transaction increases capital cash and increases equity at the same time. You have received $100,000 by issuing shares. This money comes and you deposit in the bank or you have it in cash. So you'll find that the accounting equation here is assets is equal to liability. Here will be zero. They are not liabilities. You have only issued shares, you have received equity, and this money has gone in form of cash or bank. So at this point, you already know total assets is equal to total equity. After the company formation, Speakerline needs to buy some equipment for installing speakers. So it purchases 20,000 of installation equipment from a manufacturer for cash. In this case, Speakers Lines use its cash to buy another assets so that asset account is decreased from disbursement of cash and increased by the additional of installation speakers. So what happens from this 100,000 he had cash, he has decided to buy speakers. So the amount of cash will reduce by 20,000, which has been used to buy speakers. Speakers come in as a form of assets. Yeah, but equity still remain the same. So in this case, we are saying assets, which is 100,000, will reduce by 20,000, but speakers come in which have the same amount. So the total assets still remain 100,000. The only thing which has reduced is cash, which was 100,000, now it's 80,000, but you have bought speakers. Now, after 6 months, Speakerline is growing rapidly and need to find a new place of business. Ted decided it makes the most financial sense for Speakerline to buy a building. Since Speaker does not have 500,000 in cash to pay for the building, it must take a loan Speakerline purchases $500,000 building by paying $100,000 in cash and taking out $400,000 mortgage. This business transaction decreases assets by $100,000 cash dispersed and increases asset by $500,000. Which in new case, now we introduce a loan of $400,000. So what is happening here? From the line of business, this business want to buy a building, but it does not have enough money. What does it do? It is saying it goes for a mortgage. So when you go for a mortgage, is a loan you're going to take from bank, meaning this mortgage will come as a liability, but you record the building which you have acquired through that mortgage. So the building will be recorded as 500,000 because it has been acquired, but the amount of cash will go down by 100,000 because you took 100,000 to buy that building. So the cash reduces by 100,000, but you have acquired a loan of 400,000. So the new treatment here is 500,000, you minus 100,000, you get 400,000. So the assets you'll have 400,000, but the liabilities will also be 400,000. That's the sense we're saying that in this case, all assets must balance with your equity and liabilities. So as you can see, all this transaction, there is always a status of balance. That means you'll find in each and every transaction, you maintain the accounting equations such that the assets is equal to liabilities plus equity. I hope I'm clear up to that point, unless there's someone who has an issue. So I would like you to look at this transaction. You are told that ABC Limited issue share capital 2,500 in cash. Before the transaction, assets minus liability. Look at, before you make this transaction, you had the total assets, which were 10,000, liabilities were 5,000. So equity becomes, why am I saying this? If you come to accounting equation, we said asset is equals to equity plus liability. You can rearrange this such that when you bring equity or you bring liabilities on the other side, you find that assets minus liability should give you equity. This is the same equation, only that I have rearranged and placed liability on the other side of the equation. This was before the transaction. So if you buy additional shares in cash, what happens is now your assets becomes 12,500. They were initially 10,000, but you have added cash 2,500. They are now 12,500, but it has not affected your liability. So what is going to increase is your equity. Equity is as a result of issue of shares. So you see, the equity has increased from 5,000 to 7,500. Asset has increased from 10,000 to 12,500. So the accounting equation still remains. Now, this treatment here is explaining about the cash, the assets. This is how the assets were changed, and this is how the equity were changed. Example 2, ABC Limited pays a dividend of 500 in cash. Before the transaction, assets were 10,000, liabilities were 5,000, and equity were 5,000. Now, can you explain what will be the changes when you pay dividends 500,000? I need to see the answers. Tell me what will be the new value of assets and what else will be affected. assets 4,500, equity. Now, equity. Okay, I agree with you. You are giving out cash. You are giving out cash means that the total amount of cash you have will reduce. Are we there? The total amount of cash you have will reduce. When you reduce the amount of cash here, definitely is going to have an effect on the left-hand side. So what is going to happen here is you reduce the amount of cash from 10,000, you get 9,500. And on the other side, equity will reduce to 4,500. Because we are saying assets 10,000 minus 500, equity 4,500 because of 5,000 less 500. I think you are very much correct. Now, that means that we are at the same pace. Transactions that affect liabilities and equity of an entity, we are saying that this transaction result in the increase of liability, which offset equal decrease in equity. That means these are entries that occurs on the same side. An increase in liability will be matched by an equal decrease in equity and vice versa, causing accounting equation to balance after the transaction are incorporated. For instance, ABC incur utility expense, which remain unpaid at the end of the period. What this happens is you have not paid this expense, meaning that you have not reduced your cash. But what is happening is that your liability will increase because this expense was meant to be paid and it has not been paid. Now you have what we call accrued expenses. These are expenses which now becomes your liability. Therefore, your liability will increase, and then your equity will also come down because these are expenses that you have not paid. So we are saying when you have unpaid expenses at the end of the year, liabilities are going to decrease. The liability are going to increase because you have not paid, and your equity is going to decrease because of accrued expense. If you have not paid, liability increase, your equity decrease. Now, I want to look at how to prepare a balance sheet. There are two ways we normally follow when you want to prepare a balance sheet. The first one is called a T format. A T format is the one that you can see here. We have non-current assets. Non-current asset here, these are assets that can be used for more than 1 year. We have land and building, plant and machinery, fixtures, furniture and fittings, motor vehicles. We also have current assets, and this is going to give you the total assets. On the other side, we have capital, non-current liabilities. These are example of bank loans. Current liability, we have overdraft, creditor, prepaid, accrued expense, like the one we had mentioned above. All those are current liabilities. So this is the first format of preparing a balance sheet. Another way you can prepare a balance sheet is through the vertical format. No much difference in terms of content. You are going to have the same non-current assets. You have land and building, plant and machinery, fixtures and fittings. Then we have current assets, which is going to give us the total asset in this format. When you add this one and this one, they give us the total asset, which should balance with capital and liability. Capital, then we have long-term liabilities and current liabilities, so that this total and this total be the same. Good. I'm seeing a question here. Let me see. Oh, you are asking 500 unpaid does not affect asset. Correct. You see, you have not paid your bills. You have not paid your bills, mean your money is still there. So your asset is not affected. The only thing you have done, you have increased liabilities. These are liabilities that you are going to pay. Yeah. So assets is not going to change because this money has not gotten out of your business. Now, that's how we prepare a balance sheet. And we are saying that non-current assets are listed in order of performance as shown from land and building to motor vehicle. The current assets are listed in order of liquidity. Which asset is far from being converted into cash? For example, stock is not yet sold, not yet realized. Then what is sold, we either get cash or debtors. When the debtors pay them, the debtors may pay by check or cash. So when you're recording your assets, you see you record it with the order at which you can easily convert them to cash. You see this one come at the bottom here. Even you cannot start have motor vehicle then land and building. Yeah, there is an order of this. Although that is, we normally pay very little attention at this stage when the order of which you arrange these assets. But this point is key as we move forward in the future courses. So of course, after this, we'll have financial reporting and analysis, both in section 3 and section 6. Now, I have a question here. Kamau has a business that has been trading for some years. You are given the information below. You are required to prepare a balance sheet. I'm giving you 10 minutes. You tell me what are the total assets and what are the total liabilities. That means you tell me the total asset, the accounting question. Tell me the total assets and tell me what is the total capital end. And I will also ask you the items that are capital and the one that are liabilities. So have 5 minutes and look at this. Are you there? What are your total assets? Okay, it appears. Now, look here. A quick one. Building these are long-term assets. Furniture are long-term assets. Motor vehicle are long-term assets. Stocks are current assets. Debtors are current assets. Cash and bank current assets. Cash in hands current asset. creditors, current liabilities, capital is capital, loan, long-term liability. So when you add this 1, 2, 3, they should be the same as the rest above. Yeah. I'm seeing you have given me an answer. Assets 148,200. Liabilities 143,200. Okay, let's see where you went wrong. You are required to come up with the balance sheet. This is how the balance sheet will look like. Yeah. Assets, non-current assets are 44,600. Current assets are, this is 1, 2, 3, 4. 1, 2, 3, 4. That's 2,000. So the total assets is 76,000. Yeah. And then here we have capital, bank loan, and creditors, 76,000. The accounting equation balances. I hope you are able now to make corrections. The total assets were supposed to be 76,000, not 146. Now, that is the first illustration. Let's have another one. D. Mwangi has the foreign asset and liabilities on that 1st April 2012. And then you're told that has creditors, equipment, motor vehicle, stock, debtors, cash, and cash. During the first week of May 2012, Mwangi bought extra equipment on credit for 5,520, bought extra stocks by check for 22,280, paid creditors by check, debtors, and finally put extra cash into capital. You are told you determine the new amount of capital. Determine the new amount of capital and then draw up a balance sheet after the above transaction have been completed. I give you 10 minutes. Give me the amount of capital. Capital at the end or at the beginning of May. No, we are told during the first week of May 2012. That means this took place on the first week of May. So I need the amount at the beginning and then draw balance sheet after the above transaction have been completed. So give me the capital. What is the amount of capital? Okay, you are silent. Chat, please comment on the chat if you are still working on it so that I know whether to proceed or not. If you are stuck as well, let me know. You can see a comment here. Oh, you're still working, correct? Let me give you time. Still working capital is 98,460. We say that assets less liability give you capital. So what asset do we have? Equipment assets, motor vehicle asset, stock asset, debtors asset, cash asset, cash asset. So you add all these, you minus creditors, you'll get capital. Yeah. Bought extra equipment on cash. No, bought extra equipment on credit. Asset increase and creditors increase. Asset will increase, creditors will increase. Bought extra stock by check. Stock will increase, bank will decrease. Stock will decrease, stock will increase, bank will decrease. All of them are assets. Paid creditors by check. Creditors will decrease, bank will decrease. The opposite side of the equation, asset and liabilities. Both are going to decrease. Debtors paid 3,360 by check. Debtors will decrease, bank will increase. And 240 by cash. Debtors will decrease and cash will increase. Yeah, that is the treatment. Cash, debtors reduces by 240, cash increases by 240. Mwangi put in extra 1,000 cash as capital. Capital will increase and cash will also increase. You are bringing money, cash increase, capital will also increase. So that is the computation there. So here you have the total assets. You have the creditors. The difference gives you the amount of capital. I hope, did you have this one from your answer? No, you had 98,000. So this is the correct amount of capital. You have all the assets, you less liabilities to get capital. Now, the balance sheet, sorry, I've moved very fast. Did you draw up the balance sheet? You are told that to draw up the balance sheet, we consider the effect of the above transaction. We are saying that one, buying extra equipment means that equipment balance will increase by 5,520 and the creditors will also increase by the same amount. You have bought equipment, but you have not paid. So creditors will increase and equipment will increase. Buying extra stock by check means that the level of stock goes down by 2,280 and the balance at bank reduces by the same amount. Yeah. The stock will go up, but bank will go down. Both are on the same side of the equation. They are assets. So they cancel out. Paying creditors by check reduces the balance of the creditors and also reduces the balance of the bank. They are on the opposite side of the accounting equation. Debtors paying the firm reduces the debtor amount. You have debtors who have paid you. That means the amount of debtors will come down. But also your money will go up and increase the cash at bank. Both bank and cash treatment will be the same. Additional 1,000 in cash will increase the capital and the cash will also increase. I hope I've made that clear. So the treatment will look like that, and then the equipment will increase by this amount. Motor vehicle is not affected. Stock will increase by this amount. Debtors will reduce. Cash at bank will increase. and also reduce. Cash will also behave the same. Creditors will be this value, and then when you get the difference between asset and creditors, the capital will be that. So you can draw up now the balance sheet. Your new balance sheet will look like that. Equipment, motor vehicle, current assets, and current liabilities will end up giving you that as your capital. You have something to tell me? No, sorry. Motor vehicle is not a liability. Motor vehicle is an asset. Yeah, I can see you have said clear. I will have to do more practices. Yeah, this is introduction. By the time we start solving complex calculations, I expect that you will do more practices on this area. Unless there's a question, is there a question? Comment on the chat if the lesson was good. I am waiting to hear from you. I can see you are saying that I'm okay, we are good. Okay, let's meet next week and we move at the same pace so that we complete the syllabus in good time. Otherwise, let's stop there for today. It's a goodbye.